Is it normal? Quick question. Is it normal for the SPX to be cheaper than its corresponding futures? What is the SPX right now?
SPX is about trading close at 57.51. So it's about $50 lower than where even the S&Ps are right now.
It's about $50 lower, SPX. Okay. So is it normal for the SPX to be cheaper than its futures? What do you think?
Normal?
Normal.
Like Abby normal?
They're the exact same thing, right?
Yes.
So the reality here is that
it's going to depend on interest rates. It's more normal in the past than it has been recently.
So it's really just a function of cost to carry.
That is correct.
Okay.
The cost to carry of the synthetic equivalent of the stock position that you would have.
I agree. It is just about cost to carry. Let's go next. Let's go to the first slide. It's a little heavy here, but we thought this might help people because they're the exact same product, the S&P 500 and the SPYs and the ES, but why are they different in price? Well, the S&P 500 is the most popular index watched by investors all around the world. There are multiple underlying instruments that track it closely, including the SPX, the SPY, and the ES futures. The SPX and the ES futures are priced very similar. The fundamental difference is that SPX is a cash index and cannot be traded, whereas the ES represents the futures contract, which is tradable. Okay? Mm-hmm. Next slide. Not sure what little S&P's up on the day. NASDAQ actually up on the day.
NASDAQ down on the day by 2.
Oh, it was just up. As of October 8th.
Basically unchanged on the overall market.
Yeah. As of October 8th, ES is trading at a premium to SPX, roughly 47 points higher. This raises the question, is the ES always priced higher than SPX, or is this an outlier event? So why does
an outlier event? Let's throw that.
It's not an outlier.
Okay.
So why does this discrepancy exist if they both track the same basket of stocks? And let's take a look. Like we said, it's going to be all about cost to carry. Next slide, please, John. The difference represents the cost to carry priced into the futures and dividends, which includes dividends on the S&P 500 stocks, and the interest rate cost to finance the portfolio for the duration of the futures contract. The reason we're doing this segment is just to point out to you that there is in the SPX, the dividends in the SPX, the dividends are included.
No dividend in SPX. So let's
they're already built in, but the
equivalent stock position.
The cost to carry the equivalent stock position is not. In the ES,
bonds buying some at 121 again.
Bonds back to 121. In the ES, the cost to carry and the interest, the cost to carry and the dividends are built into the price of the actual future. In the SPY, the cost to carry the stock and the dividends are neither of those are built in. Let's go next slide. So because the ES trades close to the expected forward value at settlement date, the formula is as follows. That's the S formula. And we laid the whole thing out, the risk-free rate, the dividend yield, and the time to maturity. Let's go next slide.
Think about it. If it wasn't factored in, there would be an ARB there. This is why there is no ARB there. That formula right there is why there is no ARB in this play.
Whether ES trades at a discount or a premium to SPX depends on the relationship between interest rates and the dividend yield. Just think about it this way. If the interest rate exceeds the dividend yield, the ES will likely trade at a premium. On the other side, if the dividend yield is higher than the interest rate, then ES will trade at a discount. And right now, the interest rate exceeds the dividend yield. So the ES trades at a premium. For the last couple of years, the dividend yield, which is I think it's 2.6% or something, was higher than interest rates. So the ES will trade at a discount. But right now, the dividend yield, let's say it's the same, 2.5%, I'm just guessing, and the dividend yield is 4%, then it's going to trade, then ES will likely trade at a premium. Let's go next slide, which is where we are today. In the past 30 years, there have been 4 major periods where the ES was priced higher than the SPX, okay? Only 4 periods in 30 years. Mm-hmm. Let's go next slide. Good when you see the visual that way. These periods coincide with times when the Federal Reserve increased interest rates, confirming that fluctuations in interest rates play an important role in creating discrepancies between the ES and the SPX. So again, when this all happens when the Fed raises rates and the cost to carry is greater than the dividend yield, that's when you get that kind of inversion. Mm-hmm. Let's go to the next slide. In June of 2022, the Federal Reserve announced a shocking 75 basis point rate hike for the first time in almost 3 decades, which immediately resulted in an increase in the ES to SPX spread. We're just giving you some examples here. Again, there's nothing here that's tradable.
Just give me the reason why.
Yeah, there's nothing here that's necessarily tradable. It's just the reason why.
Buying back more of that spread you put on.
Oh, buying back more of the
75, 77.
Yeah. Yeah, those were just some trades we made the other day just to try to take advantage of, to try to take a little bit of advantage
Crude oil.
of crude oil. Yeah. So when I do that, what I do then is I roll,
Down your calls.
roll down my calls, keep my other stuff in line.
Very dynamic there, Sadnov.
Let's go to the next slide. So here are the statistics showing the percentage of times the ES is higher than the SPX. These results are consistent with our previous discussion. However, since the Fed has started reducing interest rates and is expected to continue doing so, we might observe a tightening of the spread in the future. So the percent of the time that the ES is higher than the SPX, and again, this is not something that's tradable. It's just something so you understand when you look at the numbers, kind of what's going on. For the last 30 years, 54% of the time, since 2008, 25% of the time, but since 2022, 85% of the time, because we've been in a rate hike environment for the last 3 years. So just to give you, if that helps, put some context, because what happens is people roll the futures from 1 month to the next, and they go, why am I paying for this? Or I used to do this at a discount, or why am I doing this? Why am I paying for this now when I used to do it at a discount, or why am I doing this at a discount when I used to pay for it? That's all. It explains it. Let's go to the next slide. So for takeaways, the ES and the SPX both represent the S&P 500, but they can trade at slightly different prices due to the cost of carry in futures trading. The gap between these two prices is influenced by the relationship between interest rates and dividend yields. However, this gap doesn't necessarily indicate arbitrage opportunities, as everything has already been priced in. And if you see interest rates go back to 2.5 and dividend yields are 2.5, then the thing is going to trade exactly the same price.
Exactly.